Hi there. How are you? This is Keith Singer of Singer Wealth. I want to talk to you today about inflation. At the end of March, the inflation rate was about 7.9%. That means we're all seeing prices rise rapidly. When we go to the store to buy things, prices are going up. And what's unique about this particular period of high inflation is that never before, at least since World War II, have we had low interest rates and high inflation. So when we used to have 10 or 12% inflation in the 80s, you could make 10 or 12% in the bank, right? Now, we're having 8% inflation almost, and your bank isn't paying anything. So what I want to talk to you today is, what do we do with the money that you want safe and liquid, but you don't want eroded by inflation? Now, everyone has some money that they want safe and liquid. For instance, even me, 5 years ago, I had a need for some safe money, even though I'm a growth investor growing for the future. At that time, I had a son who was 17, a senior in high school, and another son who was a freshman in high school. And I wanted to make sure that I had money set away for college. So I couldn't risk that money being eroded by a bad stock market if I needed it in a few years, right? So I couldn't invest in stocks, and I didn't want to invest in bonds, and the banks weren't paying much. So I actually put $100,000 in a no-load insurance contract. And 5 years later, my son just graduated from Wharton, and I didn't actually need that money because I had other sources of income to use to pay for college, and my other son's a sophomore in college. And that 100,000 that I put away with no stock market risk and no interest rate risk and fully liquid, 5 years later is worth 136,000. So 36% in 5 years on money that was safe and liquid. So I'm going to share with you that strategy that I use personally, and that also we are using with a lot of success with many of our clients. So I'm going to share my screen, and I'm going to give you a little presentation. When we talk about no-load insurance contracts, this is for people that don't want investment risk, right? You don't want to lose money if the stock market goes down. You want to make sure that the credit risk is really low. If you're going to let someone hold your money or lend money to someone, you want to make sure that they're a highly rated institution that's going to pay you back. The problem with bonds, you can lend money to the federal government. That's a very highly rated institution, obviously, really no credit risk, because they can print all the money that they want. But we've seen there's interest rate risk. If interest rates go up, the value of your bonds go down. And they may not be liquid unless you want to take a loss. And then finally, inflation risk. It's hurting all of us. No matter what we're doing, we need to try to keep up with inflation risk, because if we have 100,000 in the bank and we have 100,000 next year in the bank, unfortunately, it's going to buy a lot less than it bought a year before. So we need to make sure that our money is going up. Even though we may not have lost money and it feels safe, we can see firsthand that it's not that safe. So what can we do that gives us safety, good returns, and liquidity? Can we get all three of those in one vehicle? Well, our solution has been no-load modified endowment contracts. These contracts were actually created by an act of Congress in 1988 called TAMRA, and it was actually designed to reduce the tax treatment, the favorable tax treatment of overfunded life insurance, because wealthy families were using that money to sock it away, not pay taxes on the gains, take it out tax-free, and also have tax-free death benefit. So now here's the new rules. If you're going to use this strategy of an overfunded insurance contract, it grows tax deferred like a deferred annuity. It has taxable withdrawals when you take out the gains. That's going to be ordinary income, but not until you take them out. There is a 10% IRS penalty, extra tax rate on gains withdrawn if you're younger than 59 and a half. And there's also a tax-free death benefit. Now, unlike bank accounts, which you're taxed every year, and bonds, which are taxed every year, you only get taxed if you actually spend the money. And if you never spend the money, unlike deferred annuities, unlike IRAs, all the money goes tax-free to your heirs, and no one ever pays any taxes, which is really great. Now, the game changer for us is about 7 years ago, we've identified some highly rated insurance companies that were allowing us to design these without upfront loads. Okay, so a lot of times if you put money into an insurance contract, you put in $100,000, your money might only have 90,000 working. In this case, the whole 100,000 is going to work from day one. There's also no back-end surrender charges, which means you can take the money back whenever you want. That's fully liquid. Now, it does take 1 to 2 weeks after you request your money to get it back. It's not like walking into a bank branch, but if you can live with a 1 to 2 weeks of liquidity delay, then this could be a great strategy for you. Now, when we started using these contracts 7 years ago, the contracts were offering 3% minimum interest for the life of the contract. Now, because interest rates are lower, the new contracts are offering 2.5% minimum interest for the life of the contract, minus insurance costs. Let me talk about that for a second. The insurance costs are projected by the insurance company based on your age and your sex and your health. And so we can't really tell you exactly what they're going to be. However, the insurance costs we've seen currently for the people that are working with us are about 1.5%, 1.6%, which means if you're guaranteed 2.5% minimum interest and the contract is promising, if you're guaranteed 2.5% minimum interest by a contractual guarantee and the insurance costs are 1.5%, if that's what they were for you, then you'd be making 1% no matter what. Now, you could make additional interest. We're not doing this to make 1% interest, even though that's better than the bank. We're trying to make more. And so what happens is you get additional interest based on the performance of a stock index that you get to choose. It could be the S&P 500. It could be a smart beta index. It could be European stock index. And sometimes some of the indexes have caps, some don't. But the ones that don't have caps historically have back tested that you would have earned about 6.5% per year for the last 20 years. Now, is that guaranteed? Of course not. But you are going to make more than the bank under current insurance costs and minimum guaranteed interest, but you have a chance to make a lot more. Now, the nice thing about these, they all have what's called annual reset, which means if we do get a bad stock market where it's down 30%, the next year you make money from gains from where it ended the year before. So if the stock market crashes, we don't need it to come all the way back to start making additional interest. Every year starts over. And there will be some up years. Even in a bad 10-year period, you'll probably get 4 to 5 up years in a bad 10-year period. So if you're interested in something like this, we would actually get an illustration from the insurance company, which would show you the exact promises, the exact insurance costs, and what you're projected to make. Now, additionally, these costs do give you some benefits. You're not just paying a cost for nothing. If you pass away, and everyone does die eventually, there's a large tax-free death benefit. So for instance, obviously, again, you need to see the illustration based on your age, but if you were 60 years old and you put $100,000 in, there might be $200,000 of death benefit, which is really great because that would be tax-free. We had a client who was 73. She came to us and said, I had a CD coming due for $180,000. What can I do that's safe and liquid? We put it in this. She made about 6% a year for 3 years, and then she died unexpectedly. And her heirs got $350,000 for that $180,000 that she put in, and they got that tax-free. Now, what's interesting is that a lot of these contracts are having a long-term care chronic illness benefit, which means that if you can't do 2 out of 6 activities of daily living, then you will have access to a chunk of that tax-free death benefit while you're alive to pay for long-term care. Okay, so people aren't dying at 70 and 75 anymore. They're living to 95 and 100. And according to the federal government, 70% of us who reach age 65 will need some long-term care. They won't be able to take care of themselves, and it's expensive currently. It's $50,000 a year for home care, $100,000 a year for nursing home. So this is a great extra benefit. Now, we have a lot of clients who couldn't care less about that benefit. All they want is a safer place to put money that's safe and liquid. But it is nice to know, especially if that's important to you, that that comes with it. So this does have the credit risk of the insurance company. We like to use A+ rated insurance companies because if an insurance company gets downgraded from A+ to A, we can decide maybe we want to take our money out and do something else, right? There's no investment risk. There's no interest rate risk. If interest rates go up to 6% and we want to buy a 6% CD, we can do that, no problem. Okay, and there's no liquidity risk. I said it takes about 1 to 2 weeks to get your money back, and most people can live with that. So we are an advisory firm. This is provided for informational purposes. Obviously, before you do anything, you want to consult with your advisor and get detailed projections from the insurance company, which outline all the costs and benefits that you would be entitled to. Anyway, if you need to reach us and you're looking for a way to use your safe money more effectively, more efficiently, call us at 561-998-9985 or go to singerwealth.com. We're looking forward to speaking with you. Thanks for tuning in. We'll talk to you soon.